From the 14th to the 17th of September 2007, customers stood in long queues outside Northern Rock branches across Britain, desperately trying to withdraw their savings. In an age of online banking, deposit insurance and sophisticated financial regulation, people were doing something that hadn't happened in the UK since Victorian times. They were staging a full-blown run on a retail bank. The trigger came on the 14th of September when the Bank of England announced it was providing emergency liquidity support to Northern Rock. The announcement was supposed to reassure people, but it didn't do that. Instead, it had the opposite effect. Within hours, the queues began forming, and over the next few days, £4.6 billion would leave the bank as panicked depositors raced to get their money out. On the 17th of September, the government finally stepped in with a sweeping guarantee. All retail deposits at Northern Rock would be protected. The queues disappeared, but the damage was done. What had started as a simple liquidity problem, Northern Rock couldn't access funding in frozen wholesale markets, had now morphed into a full-blown confidence crisis. Officials were quick to point out that Northern Rock was solvent at the time. The bank's mortgage assets were solid. The problem wasn't what Northern Rock owned, it was how they'd funded it. But in a bank run, that distinction doesn't really matter much when you're standing in line wondering if your life savings are about to vanish. This was Britain's first modern bank run, and it would force the government into guarantees that would eventually stretch to over £51 billion in liabilities. To understand how Northern Rock ended up in those queues, we need to rewind a decade. On the 1st of October 1997, Northern Rock did something that seemed perfectly sensible at the time. It demutualised. The Newcastle-based building society, owned by its members, became a publicly traded bank, and then it grew fast. Between 1997 and 2006, Northern Rock's assets exploded from £15.8 billion to £101 billion, almost 7 times larger in less than a decade. Most of that growth came from residential mortgages, and on paper the business looked simple. Lend money to home buyers, collect the interest, make profit. Easy. But here's where the story gets a little spicy. In 1997, Northern Rock funded itself the old-fashioned way. 62.7% of its liabilities came from retail deposits, regular people's savings accounts. By 2006, that figure had collapsed to just 22.4%. The rest came from wholesale markets and securitization, financial instruments that sound sophisticated but essentially meant that Northern Rock was borrowing from other banks and investors to fund its own mortgage lending. This was a funding model built for fair weather. As long as those wholesale markets stayed open and willing to lend, then everything worked perfectly. Regulators at the time noted that Northern Rock's mortgage assets themselves looked solid. People were paying their mortgages, default rates were low. Nice. But what happens when those markets stop lending? Well, you run into a bit of a jam. So, how exactly did Northern Rock fund all that growth? From 1999, Northern Rock became a pioneer in something called Securitization. They set up a structure called Granite, a master trust based in Jersey and the Channel Islands. Here's how it worked in plain English. Northern Rock would bundle up thousands of mortgages, sell them to Granite, and Granite would issue securities backed by those mortgage payments to investors. This provided Northern Rock with roughly 50% of its funding. From 2004, they added covered bonds to the mix, another way of borrowing against their mortgage book. The FSA would actually later tell Parliament that Granite's structure met industry norms, and that was true. Lots of banks were doing similar things, but diversified funding can turn into a huge problem when markets shut down. If investors suddenly don't want to buy your securities, you've got a major problem. Then there were the together mortgages, loans that would come back to haunt Northern Rock. These allowed borrowers to take out mortgages worth up to 125% of their property's value. Even as Northern Rock was on emergency life support between September 2007 and February 2008, they continued writing £1.8 billion worth of these high-risk loans. The warning signs started appearing months before the September crisis, but not everyone was paying attention. On the 27th of June 2007, Northern Rock issued a profits warning. The market's reaction was immediate and brutal. By mid-July, the bank's share price had fallen roughly 30% from its January high. Something was clearly wrong. Behind the scenes, regulators were flagging concerns. As early as April, officials noted the risks building in wholesale funding markets. The Bank of England's Financial Stability Report highlighted vulnerabilities in banks that relied heavily on wholesale funding, though it didn't name Northern Rock specifically. But here's the thing about warning signs: they're only useful if someone acts on them. The FSA later argued that the real issue wasn't Northern Rock's rapid market share growth per se, but rather inadequate stress testing and funding resilience. In other words, Northern Rock hadn't properly planned for what would happen if wholesale markets froze. The supervisors understood that liquidity, having enough cash on hand, could be a problem, but they underweighted it. Capital ratios and solvency got more attention than funding models. By summer's end, Northern Rock's vulnerabilities were becoming clearer. The question was no longer if something would go wrong, but when. And here's where things got rather ironic. On the 29th of June 2007, just 2 days after Northern Rock's profit warnings, the FSA approved the bank's Basel II waiver. This was a big deal. Basel II was a new international framework for banking regulations, and under its rules, Northern Rock could use its own internal models to calculate how much capital it needed to hold against risks. The result? Northern Rock's risk-weighted assets for mortgages dropped dramatically from 50% to just 15%. No conflict of interest there at all. Less than a month later, on the 25th of July 2007, Northern Rock announced a 33.3% increase to its interim dividend, explicitly citing these lower capital requirements. The message to shareholders was clear: we're so safe that we need less capital, so here's more cash. But here's the thing: the regulatory framework was obsessing over capital, solvency, while the real threat was liquidity. Northern Rock had plenty of capital on paper, but what it was rapidly running out of was cash, as wholesale funding markets began to freeze. The FSA would later insist that the waiver process was entirely standard and that Northern Rock's crisis was about liquidity, not capital, and technically they were right. But the timing tells a story of misaligned priorities. While regulators were signing off on capital relief and the bank was raising dividends, the funding model that kept Northern Rock alive was already starting to crack. Before the public knew anything was wrong, alarm bells were already ringing inside the regulatory system. According to academic reconstructions, particularly work done by economist Hyun Song-shin, Northern Rock contacted the FSA on the 13th of August 2007 and the Bank of England on the 14th of August with increasingly urgent warnings about funding problems. Wholesale markets, which Northern Rock depended on for the majority of its funding, were freezing up. The subprime mortgage crisis in the United States was spreading fear across global financial markets, and suddenly nobody wanted to lend. This gave regulators roughly a month between the internal alarm and the public run. A month to figure out a plan, coordinate a response, work out messaging, all that good stuff. It's worth noting that these August dates come from scholarly reconstruction rather than formal published diaries or official minute-by-minute logs. The exact timeline remains somewhat contested, with different accounts offering slightly different versions. But what's clear is that by mid-August, people inside the system knew Northern Rock was in serious trouble. The challenge now facing regulators was unprecedented in modern Britain. How do you rescue a bank without triggering the very panic you're trying to prevent? How do you provide emergency support discreetly, and what happens when that discretion fails? By early September, those questions were about to be answered in the worst possible way. The crisis went public with devastating speed. On the 13th of September 2007, around 8:30 in the evening, BBC business editor Robert Peston broke the news. Northern Rock had approached the Bank of England for emergency funding. The story hit like a bomb. Within hours, it was the lead item on news broadcasts across the country. The next morning, on the 14th of September, the Bank of England made it official. They announced a secured liquidity facility for Northern Rock, carefully noting that the FSA judged the bank to be solvent. The statement was meant to be reassuring. Northern Rock's assets were fine, there's just a temporary funding issue. Everything was under control. Nothing to see here. Please move on. The public heard something very different. A major bank needs emergency support. So by mid-morning, the queues had already started forming. And here's the irony. The Bank of England's governor, Mervyn King, had warned just days earlier, on the 12th of September, against providing easy liquidity support to troubled banks. His concern was a moral hazard. If you rescue banks too readily, you encourage reckless behaviour. But as the risk of contagion grew, with Northern Rock's problems threatening to spread to other institutions, King reversed course. And that worked great for the financial system, and everything was fine forever. In reality, the result was transparent support without solid depositor protection messaging, arguably the worst of both worlds. The announcement confirmed that there was a problem, but didn't adequately reassure people that their money was safe. Great work. So, within just 24 hours of the Bank of England's statement, Britain had its first retail bank run in over a century. The trigger had been pulled. Within days of the queues forming, £4.6 billion of hard cash had left Northern Rock in withdrawals. Television cameras captured scenes that looked like they belonged to a history documentary, not 21st century Britain. People stood outside branches, clutching withdrawal slips, some visibly distressed, while staff inside tried to process the exodus as quickly as possible. On the 17th of September 2007, 3 days after the Bank of England's announcement, the Treasury finally stepped in with what everyone had been waiting for: a blanket guarantee of all retail deposits at Northern Rock. The queues disappeared almost immediately. The guarantee worked, but that was just the beginning. On the 9th of October, the tripartite authorities, the Treasury, Bank of England and FSA, working together, extended the guarantee to cover new retail deposits as well, not just existing ones. Over the following months, the net widened further. By December, certain wholesale obligations were included. When the dust settled, government guarantees ultimately covered up to £51 billion of Northern Rock's liabilities. £51 billion. The British state had become the backstop for a private bank. Officials were quick to frame this as a systematic stability measure, not a shareholder bailout. The guarantees were necessary to prevent contagion, to stop Northern Rock's collapse from triggering runs on other banks. And that argument did have merit, but the reality remained. Taxpayers were now on the hook for a bank that had bet its business model on wholesale markets staying open forever. The guarantees stopped the immediate crisis, but the question of who would ultimately pay for it was still wide open. As the government's safety net expanded, important questions emerged about exactly what and who was being protected. On the 18th of December 2007, the Treasury extended guarantees to cover certain unsubordinated wholesale obligations. This meant some of the money Northern Rock had borrowed from institutional investors would also be protected by the government. The goal was to keep funding lines open and prevent a disorderly collapse. But there were limits. Covered bonds and granite securities, remember those, the securitization structure that provided roughly half of Northern Rock's funding, well, they were not covered by the government guarantee. This might sound like an arcane technical detail, but it mattered enormously. These exclusions shaped who would take losses, who would be made whole, and what incentives were created for future behaviour. Retail depositors, ordinary people with savings account, got full protection. Some institutional creditors got protection, but investors who'd brought securities backed by Northern Rock's mortgage book, they were on their own. The government argued these limits were necessary to reduce moral hazard while still keeping the bank functioning. If you guarantee everything, you remove any incentive for investors to be careful about who they lend to. But if you guarantee nothing, you risk a financial meltdown. It was an uncomfortable balancing act, drawing lines in the sand about which creditors the British state would shield and which it wouldn't. And those lines would have consequences when it came time to wind down Northern Rock. As Northern Rock lurched from crisis to crisis, heads began to roll at the top. Chairman Matt Ridley resigned on the 19th of October 2007, just after a month into the crisis. Ridley, a science writer and former journalist who'd taken the chairman role, found himself leading a bank through an unprecedented disaster. His departure was described as taking responsibility for what had happened on his watch. Executive Adam Applegarth held on slightly longer, but not by much. His resignation was announced on the 16th of November 2007, though he wouldn't formally leave until the 13th of December. Applegarth had been the architect of Northern Rock's aggressive growth strategy, the man who'd overseen its transformation from a regional building society into a national mortgage lender funded by wholesale markets and securitization. This leadership churn signalled that Northern Rock's board had run out of answers. Whatever plan they'd had for navigating the crisis clearly wasn't working. These resignations didn't fix the fundamental problem. The funding model was still broken, the guarantees were still growing, but they did prepare the ground for what would come next. Because here's the hard truth about resignations: they're symbolic accountability, but they don't solve liquidity crises. You can change every person at the top of an organisation, but if the business model is fundamentally flawed and markets won't lend to you, no amount of new leadership will make wholesale funding magically reappear. Northern Rock needed more than just new executives, it needed a buyer, or failing that, a new owner. Behind the scenes, the government was desperately trying to find anyone willing to buy Northern Rock. On the 26th of November 2007, Virgin Group, led by Richard Branson, was named as the preferred bidder for further talks. The Virgin Consortium looked promising on paper: a well-known brand, financial backing, and a willingness to take on a troubled bank. But as negotiations progressed, the financing failed to firm up. Any private sector buyer would need massive government support, guarantees, cheap loans, insurance against losses, just to make the deal viable. By January 2008, the Treasury was floating the idea of bond guarantees to enable a sale, but every bid that came in implied large and prolonged public risk. The European Commission's state aid clock was ticking. The longer Northern Rock remained in limbo, propped up by government support without a clear resolution, the more questions arose about whether this constituted illegal state aid under EU rules. On the 17th of February 2008, Chancellor Alistair Darling stood up in Parliament and announced what had become inevitable. Northern Rock would be nationalised. The Banking Special Provisions Act of 2008 received royal assent on the 21st of February. Emergency legislation was rushed through Parliament in days rather than the usual months. At 1 minute past midnight on the 22nd of February 2008, the transfer was complete. Northern Rock belonged to the British taxpayer. Shareholders would later challenge the valuation, arguing the terms were unfair, but with the state aid clocks ticking and no value for money private bids on the table, temporary public ownership had become the least bad option. We should bust a myth here that Northern Rock was just a victim of panic, a fundamentally sound bank brought down by rational fear, that the numbers do tell a different story. Between September 2007 and February 2008, while Northern Rock was on Emergency Bank of England support, the bank continued writing £1.8 billion worth of together mortgages. These were the high loan-to-value products we mentioned earlier, allowing borrowers to borrow up to 125% of their property's value. By the 31st of December 2008, the picture had become stark. Together mortgages made up roughly 30% of Northern Rock's loan book, but they accounted for approximately 50% of arrears and a staggering 75% of repossessions. These products, designed for a booming property market, became toxic when the recession hit. To be fair, about £1 billion of that new together lending honoured commitments made before September 2007. Deals that were already in the pipeline. And the bank did tighten terms in October and November 2007, finally acknowledging the risks, but the damage was done. This data matters because it challenges the "it was only panic" narrative. Yes, liquidity triggered the run. Yes, Northern Rock might have survived in different market conditions, but the product mix magnified losses when the recession arrived. The mortgage book wasn't quite as solid as regulators had initially believed. Liquidity killed Northern Rock quickly. The loan book would have killed it slowly. Fast forward to January 2010. Northern Rock, still in state ownership, was split in two. There was Northern Rock plc, the so-called good bank, containing profitable mortgages and retail operations that could be sold back to the private sector. And there was Northern Rock Asset Management plc, or NRAM, the so-called bad bank, holding troubled loans that needed to be wound down over time. On the 1st of January 2012, 4 years after nationalisation, the good bank was sold to Virgin Money for £747 million in cash, plus additional instruments and contingent payments that brought the midpoint value to roughly £931 million. Virgin Money got the retail franchise, the branches, the brand recognition, which they'd eventually retire in favour of their own branding, and the performing mortgage book. The sale reduced the state's footprint in banking. The government was finally out of the day-to-day retail banking business, at least where Northern Rock was concerned, but the loan runoff, NRAM, the bad bank, that stayed in public hands. The National Audit Office said the sale process was handled well, but noted what everyone knew. This implied a loss for taxpayers relative to the original investment. The guarantees, the emergency support, the years of state ownership, all of it had come at a cost. Ministers argued the sale maximised value given market conditions, which was probably true, but maximising value and making taxpayers whole turned out to be really different things. The Northern Rock name, once synonymous with aggressive growth and mortgage innovation, had become a cautionary tale. Within a few years, even that would be gone, absorbed into Virgin Money's branding. Northern Rock left behind 3 distinct legacies: legal battles, regulatory soul-searching, and permanent changes to Britain's banking framework. The legal front. Shareholders weren't going quietly. They challenged the 2008 compensation scheme, arguing the government's valuation was unfair. The scheme assumed Northern Rock as a going concern without state support, which meant assuming the bank had failed. Shareholders said this undervalued their holdings. On the 28th of July 2009, the Court of Appeal disagreed, upholding the compensation scheme. Later, tribunal decisions in 2011 also went against the claimants. The message was clear: if you need a government rescue, you can't then demand to be compensated as if you didn't. Then there's the supervisory reckoning. In March 2008, the FSA published its internal review, and the language was pretty damning. The FSA concluded that its supervision of Northern Rock was at the extreme end of the spectrum of shortcomings for a high-impact firm. It was an extraordinary admission. We failed badly, and we know it. Then there was the framework overhaul, where Parliament passed the Banking Special Provisions Act of 2008, specifically to nationalise Northern Rock. Emergency legislation for an emergency situation, but that was just a stopgap. In 2009, the Banking Act created a standard special resolution scheme, giving authorities permanent powers to intervene in failing banks without needing to rush emergency legislation through Parliament first. The Act also reformed deposit protection, scrapping the co-insurance that had made depositors bear part of the risk. Limits were progressively increased to £50,000 in October 2008, eventually rising to £85,000 under EU rules. Northern Rock forced the UK to bolt crisis wings onto the aircraft mid-flight and then redesign it on the ground. Some policymakers argued the response balanced moral hazard and stability, but critics noted that delays and mixed messaging made the run worse. Both were probably right. The queues outside Northern Rock branches in September 2007 had looked like something from another century. The regulatory response ensured they wouldn't be repeated. At least, not in the same way.